Hello, for me it's Sunday afternoon. I'm recording my lecture on, you can go ahead and write the title here, The Money Multiplier and the Banking Balance Sheet. I'm not going to lie to you, this is going to be pretty tough stuff. I think it's, for a lot of you anyway, I think this is going to be very likely to be on the exam, or at least some component of it. I do have a strategy here, if I can pull it off, that I'm going to write you this really detailed but small, like 3 pages note sheet that you can use on the exam. At least that's the intention right now. But you need to know how to do this in a pinch. Okay, money multiplier and the banking balance sheet. And you're going to have a quiz on this Tuesday morning. All right, so make sure you have the audio on because I'm going to go over a lot of answers and they're not going to be typed down. They're just going to be, I'm going to give them to you verbally and you have to write them down. Okay, let's talk about expansionary monetary policy. All right. So when the Fed's got 4 tools, remember, or 3.5, they can raise or lower the reserve ratio. They can raise or lower the discount rate. They can do open market operations, which is the buying or selling of T-bills, and they can target a higher or lower federal funds rate. Okay. But right now, we're specifically going to talk about the reserve ratio, what I usually call the nuclear option. If they raise or lower the reserve ratio, remember, banks want to loan out as much money as they can. And when they loan out that money, it multiplies. Okay. All right. So the ratio has been 10% for a long time. It may be lower right now. That's what Janet Yellen said in her video the other day. But we're just going to act as if this coronavirus thing hadn't happened. And we're going to say it's usually 10% because it normally is. Let's say the Fed lowers it to 5%. Here's what that means. Remember, and you want to write this down, this only applies to demand deposits or checking accounts. And so if you have $100,000 in your savings account, the bank can loan all that out. But if it's in your demand deposit, because remember, you use your checks all the time, people are paying bills, the bank is required to keep 10%. If the Fed lowers that to 5%, the bank is immediately, the individual bank, going to try to loan out that 5%. Once they loan it out, people, whoever they loan it to, are probably going to put it in their checking account, or they're going to buy something from somebody and that person's going to put the money in their checking account. But the theory is that money's going to multiply, multiply, multiply. Okay. And so, and we're going to go into detail here, but go ahead and write this down. Remember, when the money supply gets bigger, banks, I never probably did this lecture with you second semester. I usually do it where I talk about banks are pretty much a dime a dozen. They're all over the place. They've got pretty buildings, some of them, and they've got cute names or stupid names like Fifth Third, but whatever. They've got what they basically compete on. The number one thing is how close they are to your house. Now, a lot of your parents may bank miles away, but they may have moved, or for whatever reason. Generally, people, when you go get your first, when you get your first house and you have your family and all that, you're probably going to get the nearest bank to your house. Convenience is usually number one. After that, it's usually all about interest rates. So banks know if if you want a loan from a bank, you want the cheapest interest rate you can get. So if there's more money in the money supply, remember, the more you have of something, it decreases in value. But the more money in the money supply, they're going to have to drop the interest rates to get you to borrow it. And remember, when they drop their interest rates, I'm going to go ahead and click and let you write this down. When they drop their interest rates, if you remember that day we did car payments and house payments, this is go up here, not G up. But as interest rates go down, car payments and house payments get cheaper, people borrow more, and they spend it, causing aggregate demand to go up. Okay, that's what the Fed's trying to do. When the Fed has an expansionary monetary policy, they're putting more money in the supply, more money in the money supply. What they're doing is trying to cause interest rates to go down. Because if they go down, the theory is people will spend more and the economy will come out of the recession. Okay. All right. So just draw this. It doesn't have to be pretty. Here's a recession. ADSRAS, we're in a recession, okay? So make sure you show the intersecting point over here. So the easiest way to get rid of this recession is to have aggregate demand go up. If it goes up to here, if this line shifts over to here, then the recession's over. So you want to practice expansionary fiscal policy or expansionary monetary policy. And we're only talking about monetary right now. So here we go. What the heck? Okay, different graph. I worked on this earlier and forgot what I'd put here. So here's what the Fed does. It buys T-bills, or it lowers, in the case we're using, it lowers the reserve ratio. So what happens is the banks immediately start loaning more money. That causes the money supply to increase. So you see here, the arrow here is the money supply increases. What happens to the nominal interest rate? It goes down. As it go down, people decide to buy, more houses and more cars, providing jobs to other people. A lot of people right now, in the middle of this, coronavirus situation, are buying homes, buying and selling homes. I'm kind of shocked that they're doing that. There's a lot of that stuff going on right now. A lot of the interest rates are so low. Just think about what the Fed supposedly just did. I've not been able to find this. They dropped the reserve ratio to 0, according to the former Fed chairman. I've not been able to find it on Google or anywhere. But when they dropped it to 0, that means banks can loan out even more money. The Fed is doing everything they can to rescue this country from this recession. They're throwing money out there, and the interest rates are plummeting. It's very cheap right now. It would be cheap even if the interest rates, even if the Feds wasn't doing that. But here's what they're doing. They're driving down the interest rate, and here's what they want to happen. That right there. I thought I put an arrow in here. There it is. Aggregate demand goes up. Now, of course, that's going to cause inflation, but it's going to cause, you see, we're going to go from here to here. That means employment goes up and unemployment goes down, and that's their goal. They want to put people to work. Now, this is Sunday as I'm recording this, and as you know, Florida is partially opening tomorrow, Monday. They're opening 80 of the Florida state parks, limited opening, but they're trying to get people back out there. Florida has resisted opening, barbershops and stuff like Georgia has done, and massage parlors and tattoo places, but that's probably coming pretty soon. And so they're desperately trying to get these people back to work so they won't apply for unemployment. Florida's unemployment system has been a disaster, just like the Middle Ages. But what they're trying to do here is pump this thing back up. All right, moving on. Okay, so let's talk about the money multiplier. Again, I really hope you're listening and paying attention to this. This can get rather complicated, and I know a lot of you having a tough time. Again, in my theory is, of course, I've said many times in these videos, let's still hope you pass a bunch of your AP exams. Let's not make the situation worse. I want to give you every tool I can to help you save money on this college course. Okay, so this doesn't come out very well, but the multiplier formula is 1 over the reserve ratio. So and I don't know what 1 divided by 0 is as far as I'm concerned. That's 0. I don't know how that works. I'm going to have to ask somebody. I don't know what the multiplier is now, but in the general situation, it's that we've had for the past 30 years, it's 1 divided by 0.1, which was 10. So if all of a sudden you put money in the bank, it can multiply. If you put money in the checking account, it can multiply by 10. You put $100 in your checking account, the money supply can go up to 1,000. All right, same. So here's the deal. The only multipliers I'm going to give you are the same as I gave you before. And you can write these down again if you want, but you don't have to. But here's what we're going to have. So the small, easy numbers, even though you can use calculators, you don't want to take the time. And I just told you 1 divided by 0.1 is 10. So if you put $100 in the bank, it's going to multiply 10. The money supply, if you put it in your checking account, the money supply is going to become 1,000. Because you put $100 in your bank, they loan out 90. That the person they loan it to puts their money in another bank, they loaned out 90% of that. They pay that person puts their money in another bank, which loans out 90% of that, and the money keeps, it's like a ricochet. It's like an echo. I've used all these different examples. Okay, that is the formula. Now, here's what I'm going to do today. So I'm going to do a bunch of problems with you. Okay, rather than go try to lecture all this, we're going to do a bunch of problems. And then the last 2 are going to be homework problems. Just like the other day, I want you to do them and then call your buddies and check your work with them. I can tell you that last Friday's, I think I'm probably going to send an email before you get this. I think you'll get something else before you get this. Grades were not good because a lot of you messed up on that tax multiplier. But anyway, enough about that. I want you to get this right. So let's look at this. So if the Fed buys T-bills in the amount of $100 and the reserve ratio is 0.1. Now, I'm not going to draw Fed on my forehead again, but remember, I always point to my chest and say, I'm the Fed. So I'm going to take $100 out of the vault, If it's in my vault, it is not in the money supply. If I pull it out and buy a T-bill, in other words, somebody out there's holding a treasury bill. I say, hey, give me that piece of paper and I'll give you $100. So I give them the $100 and they're going to theoretically, they're going to go put it in their checking account so they can spend it. And what's going to happen is it's going to multiply. So if they buy a $100 T-bill, I think I just went over this. How much can the money supply go up? The Fed puts $100 in the money supply and multiplies by 10, 1 divided by 0.1, and the money supply becomes $1,000. Now, I want you to remember, if a person finds cash in their wallet and they put it in their checking account and they ask you, how much does the money supply go up? That's a little bit different because the cash was already M1. Once you put it in your checking account, it's still M1. So if you put $100 in your checking account, that 100 in the same scenario is still going to be $1,000. But how much did the money supply go up? Because the $100 was already in the money supply. It's 1,000 minus 1, which is $900. 1,000 minus 100 is $900. All right, so again, if you're having trouble understanding this, you want to go back and listen to this again. I know I'm going fast. By the way, this works both ways. If the Fed raises the discount rate or raises the reserve ratio, that means banks can loan out less. And so there's less money out there being multiplied. And the same thing, the money supply is going to go down, raising interest rates. All right. So here we go here. All right. So I got him at 11 minutes and 40 seconds. So let me scoot this up here. All right. So you can pause this and try this if you want. I've got my notes here. What I plan to do is go over like 5 of these things and have you have explain it to you and then have you do 2 of them. So Janet Smith, this is the year 2001. These are all the ones you're about to see were on the AP exam. That's why I feel very likely they may give you one of these this year. They do it quite a bit. Janet Smith deposits $100,000 of her cash holdings in their checking account at First Federal Bank. Key thing is checking account demand deposit. The reserve requirement is 20%. The bank has no excess reserves. Let me explain what this no excess reserves means. What that means is, to make this simple, is the bank loans out every extra penny it can. So it's going to keep the bare minimum, which is going to be 20%. So what is the immediate effect of her deposit on the money supply? Now watch the thing, key word there is immediate. She pulls $100,000 out of her cash. Let's say she's got it at home in a jar, a piggy bank. She pulls it out, puts it in her checking account at First Federal Bank. How much has the money supply changed? 0. Be on the lookout for this. They do it all the time. Because M1 is 3 things: cash, checking accounts, and traveler's checks. When it was cash, it was in M1. And in a checking account, it's still M1. So, and explain why you'd say cash and checking accounts are both components of M1. All right, so I explained it. That's 2 points, by the way. Now, what is the maximum amount of money the First Federal can initially loan out? There's the key word, initially. So she puts $1,000 in her checking account. They have to keep 20% of that, okay, which is $200. How much can they loan out immediately? $800. Explain how you determine that amount. You just say she deposited $1,000. The bank has to keep 20%, which is $200. The difference is $800, which they can loan out. You're now up to 4 points. What's the maximum amount of money the entire banking system can create? Well, now remember, her original $1,000 was, first off, she puts the $1,000 in the bank, okay? The money supply is going to go up based on that times the multiplier. The reserve requirement is 0.2. 1 divided by 0.2 is 5. So the money supply is going to become $5,000. But that $1,000 was originally in cash, so $5,000 minus $1,000 is $4,000. Be on the lookout for that. That's going to happen. You have a reason why it may not go up that much? Because people hold on to cash. Okay, let me explain that to you. What they're saying is, okay, she puts $1,000 in, it can go up to $5,000. What's the reason it might not go up that much? Well, if they were to loan it to somebody instead of put it in their checking account, they put it in their pocket, it's not going to all get multiplied out. That's another thing that's quite common. Please be on the lookout. Now, this video is about to stop here, but I'm going to do, I think, 3 or 4 more problems, and then you're going to be on your own.